Okay, so like I said, simple model. This will meet most of your needs. I like to think about cash, starting with your accrual-based revenue. So that's the numbers that are in your QuickBooks or your general ledger. That's the number that when you hear revenue recognition, that's how much cash, how much revenue your business generates. Now, some of us on the line in the market, most of our revenue is recognized on a cash basis, while others are on an accrual basis. For the most part, I would say it's probably somewhere in the middle, right? There's no really steadfast, I'm a 100% accrual, I'm 100% cash. Everybody's got their own little formula, regardless of what the CPAs tell you. Everybody does it differently. I like to look at my accrual revenue as what's in my QuickBooks. So you should start there. So here's a hypothetical situation. And then we're going to get, so you see the word base case. You can also see another case called worst case. I'm not going to focus on why the inputs are what they are. I just want to walk you all through the mechanics of how to build a simple 6-month cash flow. I will step back and talk about there are different ways and different types of cash flow planning models. The most basic model that you'll hear a lot of people talk about is a 13-week cash flow. We decided not to do the 13-week cash flow. We decided to do more of a 6-month cash flow because that's going to encompass or will culminate the effects of the PPP loan and also for those of you that have any forbearances, any deferments on SBA loans, it should capture some of your 6-month, okay? So you start with your accrual revenue. Now you got to make some level of decision because let's face it, not everybody gets to collect all of their revenue within that month. Just because I generated 100,000 in revenue doesn't mean I'm actually going to collect 100,000. So in this situation, I just assume that on average, I collect about 75% of my cash. Now you don't have to be formulaic. You can actually enter the information in directly. In this scenario, if I were to guess, you have 100,000 kind of drooping down to 80,000 in May through September on a monthly basis. Chances are, you should normally, if this was normal course of business, guys, you would probably see much more than $60,000 being collected in May. But under the distressed situation that a lot of our customers are in, especially for those that don't collect their revenue in cash on the point of sale, many of us actually have 30 days outstanding, right? Where we give customers terms. Well, unfortunately, in these times, for the most part, you should expect some customers not to ever pay you back, right? You may have sold something, but the reality is in these times, customers do deteriorate really quickly. So we start with 100 grand in revenue. We're going to collect about 75,000. So that's a great way to start a cash flow model. What's my accrual revenue and how much do I expect to collect? Now we go on to your cash balance. So this could be the culmination, the sum of all of the cash in your bank accounts, which it really should. So either you're looking at just your checking account or you're looking at your checking, your payroll, etc. Bringing all that into what was my starting cash balance on April 1st. Boom. You add to that number your 75,000 in cash that you received from collections in that month. Now, this is an estimated number, right? The 25,000 in the bank, that's cold hard cash. That's something that you can actually stop and look at your bank statement or your online portal. So now you got your cash collections of 75,000. Now, the next piece is your operating cash outflows, right? And I use the key word here, operating, because there are different types of cash flows. There are operating cash flows, there are financing cash flows, and then there's a third one, which we're not going to contemplate here. If that's your sort of investment, your fixed assets, okay? Your operating cash flow is really what you see on your P&L. So guys, if you go to QuickBooks, you say, give me a P&L for April, that's essentially what you'll see in your P&L on a cash basis. Now, for most of us, I would say from our experience, 80% of our operating cash outflows are actually cash basis. Most of us do not do things like accrual payroll, right? We actually just log in our payroll based on the cash outflow from our account to our employees. So in this scenario, we're assuming we got about $5,000 in rent, $50,000 in payroll, throw in another $5,000 in general administrative. Maybe you've got $1,000 in marketing spend, $1,500 for your typical technology. It could be your Google Apps, it could be other CRMs, et cetera, and maybe some professional expenses. You probably, let's say you're outsourcing some accounting and bookkeeping, or maybe you're outsourcing some IT work, or you've got a fractional CFO, or you've got a lawyer, right? You throw that in there, and then I kind of keep another one in reserves just to keep, be able to expand. I don't like to see more than like 5 or 6 high-level line items. We're not really trying to capture all of that granularity that you see in your QuickBooks, right? Now you take the sum of that and you subtract it from your cash inflow. So Steve, slow down 1 second. Can you expand out? So let's go back to basics. You got your cash collections of $75,000, subtract your operating cash outflows of $65,000, which is the sum of the items underneath. You subtract the two, that's a positive net positive $10,000 of operating cash flow. So this is the amount of cash that your operations in the normal course of business produces. This is known as your operating cash flow. However, we all know we've got debt payments, we've got other things. So in this case, we added another piece to this puzzle. We called it financing activities. So we all have debt repayments. So in this case, we're assuming that we have $10,000 in principal and interest. Again, if there were CPAs or true accountants on this Zoom call, they'd be like, whoa, time out. That $10,000, part of it is in my P&L, part of it is on my balance sheet. I got to tell you, for the purpose of this, we don't care. We just want to follow the breadcrumbs. And the breadcrumbs are the dollar bills going in and out of your bank account. So we're not trying to build a P&L for a banker. We're trying to build a cash flow statement for managers. So debt repayment, you got to pay the bank or the SBA $10,000 a month. But for most of us on the phone, we were lucky enough that we ended up getting a really great gift from the government, and it's part of the SBA 7A financing. If you don't know what that is, you should probably take another peek at it, but the PPP loans actually fall under this. And the government ended up paying you or depositing into your account, actually your bank did, into your account $100,000. That $100,000 is approximately 2 months worth of payroll. The numbers just, I kind of made the numbers add up quick. So if I take $100,000 in new financing minus the $10,000 that I'm paying to repay, my net, I made $90,000 in cash from financing activities. $90,000 plus my $10,000 from operating cash flow gives me a net cash flow for the month of $100,000. If I add my starting balance of $25,000 in April, of $25,000 plus the $100,000, I should expect to end April with $125 in my account. I'm going to pause here, and I'm going to say one last thing. You essentially take that column and extrapolate it out 6 months. And now the fun can begin. Because obviously there was no thought into why is my revenue dropping from 100 to 80? Why is my revenue staying flat at 80? Why have I not cut expenses, et cetera, et cetera? So if anybody has any quick questions, you want to kind of touch base, recap some of the cash flow, I'm really trying to demystify cash flow planning. I'm really trying to tell you guys it ain't that hard.
I just want to add that Corey was really helpful. So highly recommend sitting with Corey.
Thank you. I think Corey's on the line. He doesn't take compliments all that well.
Well, you know what? He was terrible. He was
Thank you, Jamie.
Kathy and Rebecca will second that Corey nod.
Corey's got a fan club.
Yeah, he does.
I'll do a breakout room right now, if that's okay.
I'm his #1 fan. No breakout rooms for you. Cool. So it's very simple, right? It's my accrual revenue. How much cash am I going to collect from my accrual revenue? These are tough times. Don't expect to collect all of your revenue. I just go into this knowing that 10 to 20% of the revenue that I recognize this month or prior months is at risk of collections. If you go into these situations, if you go into your planning cycle thinking and believing this, you're going to be better off, because again, hope for the best, plan for the worst. And it's actually quite easy. It's cash in, cash out, what's my financing activity, and my net cash balance in my bank account in 6 months. So I'm going to move on to action number 3, which is really about, we can stay here for a second, which is about, what's my view of the world, right? That's one of the beauties of planning. You get to ask yourself, remember those classes, those economics classes, you kind of get to bring a little bit of that back into this. You all have very, very different idiosyncratic businesses, that they're very unique. So everybody's going to kind of play out very differently. But we're in business, and therefore, inherently, we should have a view of the economic backdrop, the social backdrop, all of these things that are happening. We need to have a view on how those things are going to impact our business. I like to kind of talk through examples. About 6 weeks ago, I had a conversation with Steven. It was a Friday night, it was 8 o'clock. We had a couple of beers at the office, and we talked on the phone that evening, and we said, Steve, this is not looking good. It was the first week of March. This is not looking good. I wasn't really feeling it. And I said, we really need to hunker down this weekend and figure this out. And so Steven and Corey and another of our colleagues, we came in and we essentially spent 8 hours on a Sunday. And has nothing to do with finance, had nothing to do with accounting. It had everything to do with the first 5 hours was, what is this going to do to our business? And it's got to start with our customers. It's got to start with our market. It's got to start with the demand for what we produce for our customers. And we came in and we said, our company has to be ready to withstand a 25% drop in revenue and a 40% drop in cash. And those are shocking numbers, because let's face it, at the end of the day, businesses like ours and some of those that are, some of you folks that are on here, 50 to 60% of our expenses is based on payroll. It's people. And if revenue drops by 25%, there's only so much wiggle room you have on rent. There's only so much wiggle room you have on utilities. The rest of the wiggle room is going to come from people. So it behooves you. It's almost imperative that we do this. So we started by saying, if we think that we're going to lose X amount of revenue, which customers, where's this impact going to come from? So I know, Jamie, for example, your business is a little different. It's unique in this situation, but you still have to have an assumption walking into April, May, June. And by the way, I'm okay, Steve, if we change that 80,000 in May to 0. Why? Because maybe I'm in a business that had to shut down the restaurant, and maybe April I'm going to see 0 revenue in April. Instead of 100,000 in April, I'm going to see 0. C2. And so here's an example of a restaurant that pretty much collects all their cash on in that moment that they recognize their revenue. But I'm walking into this guy saying, my business is going to be adversely affected, and I'm not going to be able to open up my doors in April and May. And even though 12 months ago, in the month of June, I was doing about 100,000 in June, I actually don't think I'm going to be able to have as much capacity. I'm actually, in the month of June, going to have to cut my capacity in half. This is base case scenario. I'm saying that the economy is going to slowly open up. Things are going to slowly open up in May and June. So Steve, work with me. In May, let's go and put the revenue. So normally I do 100,000 a month. I'm going to say in May, I'm probably going to do 25,000, because by mid-May, our fearless leader, they're talking about opening up the economy. And so I'm going to build a base case off of it. So in June, I'm not going to see much of a difference, except we're going to stay open the full month of June. And yeah, there's going to be pent up demand to go out there. But the reality is, I believe that regulators are going to say, Dan's Kitchen, you cannot serve more than 50% of your normal capacity because your tables have to be spread out 10 feet apart, et cetera, et cetera. And oh, by the way, that bar, you're closing it down. I don't want people rubbing elbows. So 50,000 in June. And guys, this ain't going to go away. I'm ready to commit to 50,000 in July, 50,000 in August, and maybe by September, I can probably get back to some level of normalcy. So let's call it 75,000, but I'm still 25% off of what my historical run rate is for the month. Now, this is important because this is the basis for everything. So Steve, because I'm in the restaurant business, my cash collection ratio is 100%. So let's go ahead and change everything to 100%. And so for those of you that are lucky where you actually charge a customer, you know, the revenue is recognized and you collect that money, you swipe a credit card, they stroke you a check, you're good, right? That cash is being collected. So all in all, my cash, this looks tough. I normally do about 100,000 in revenue. And right now, I'm looking like I'm at 25 to 30% of what my normal revenue run rate would be for 6 months. Not looking good, guys, right? So cash collections were good. Let's go to operating cash outflow. So rent, I got to tell you, with $0 accrued revenue, my first call in April is to my landlord. I'm not paying the rent, 0. And frankly, I don't even know how I'm going to pay the rent in May or June, and maybe in July I can start thinking about paying rent again. Payroll. Payroll, I actually walking into April, I laid everybody off. But I was fortunate enough to get this PPP loan they've been talking about for the last like 2 years, feels like. So I'm going to rehire everybody back. I just got the money. Today is April 15th. So I'm going to bring everybody back at half of what I normally do. So let's say 25,000 in payroll in April. So I'm bringing everybody back. And I'm going to keep them all nicely fully employed in May. So let's call that 50,000. And I'm going to try to keep everybody employed. I'm doing this on purpose, right? Because the numbers just aren't going to work even with the PPP. That's the headline and all this. G&A, I'm going to bring it down to 0. I'm going to stop paying. I'm going to just cut all my expenses at least until August. Marketing's a tough one, right? Restaurants, like, what are you going to do? I'm going to cut it down to 0. I can't afford it. 0, 0, and probably 0 all the way through September. Marketing is going to be something that most companies aren't contemplating. Although I would argue that now is the time to be thinking about marketing. Technology, I would cut it down to 0. Let's just start with a nice clean baseline here. Professional expenses, you're probably down to 0. So we are down to nothing. Now, what we do need in here, because if I'm going to open up my restaurant in May, I am going to have some G&A, and let's say normally I usually do about 20%, I normally do about 50% gross profit. So let's do a 25,000 D4 times 50%. And then let's wrap that all the way across. So this is the cost of food, right? So my average gross margins is probably a restaurant business.
You need a key to get in your office?
Probably close to
No, Chloe's there.
Okay, so it's all.
So I actually just put it on the front.
Good. So now my operating cash flow looks kind of bad. I've got I'm bleeding, right? Even opening up the business a little bit, I'm bleeding. So can you go up? I can't see the bottom. Keep going. Okay, right. So now I'm looking at operating cash flows of negative, 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 negative. You know, even with $100,000 in PPP loans, I'm not able to like survive. So in April, can we zoom out a little bit? I'm trying to see the whole thing at once. So in April, I collected $0. I closed down the business. I pretty much laid everybody off. But because I got the PPP loan halfway through the month, I brought everybody back. So that's going to cost me a negative $25,000 with no revenue to offset. And let's take a look at debt repayments. So the good news is I had an SBA loan, but the SBA said I had 6 months deferment. So let's kill all those debt repayments, which is great. That saved me a couple of bucks, $60,000. I get 100,000. My net cash flow after I paid my employees and received the PPP loan was 75,000. Now, one thing this cash flow planning tool doesn't take into consideration yet is the forgiveness factor of this, which is something we'll add after. So now you're down to 75,000. The point here is you get the gist. You see how everything's rolling. Is it possible to move the names to the side? Okay, so now we have a base case. The base case here is, again, I've got a business that I shut down in April, no revenue. Our fearless leaders want to open up the economy, so we're going to maybe do 25,000 in revenue next month, and maybe we'll be open the full month in July and June, July, and August, and then in September as things start to open up. Now, the point being is we don't have a crystal ball. And that's the beauty about planning, and it's the downside about planning. You don't have to be right, and I'm guaranteeing you will not be right. So this is our best guess of what a base case looks like. So now let's create a worst case, because things may actually get worse. So we're going to take this and we're going to duplicate it, and we're going to call this worst case. Now, worst case is, again, I'm not in the restaurant business, so I'm going to use a little bit of sort of imagination, almost nightmarish. But let's say that, you know, even though our government wants to open up the economy and get people back to work and businesses open in May, there's a second wave of COVID. And we don't actually get to open up until end of June. So now that pretty much wipes out May, and it pretty much wipes out all of June. And we're really going to open up in July, but as we all know, we're not going to open up like at half capacity, right? So it's going to take a while to ramp up. So Steve, go ahead, put 25,000 in August. And let's say by September, we're really at half of what we were doing. Cool. Not cool, but cool. So I'm going to pause here. I'm going to leave everything the way it was, but let's go down to the cash flow number. So our cash flow number is at negative 115,000. We essentially end up in the end of June with $0 in the bank. You see where I'm getting this, right? The expected ending cash balance is 0. Now you got 100,000 SBA loans. But the problem is that 100,000 is depleted overnight between April and May through half of June. Because of course, we got the 100,000 in PPP loan, and the first thing we want to do is get it 100% forgiven. But I'm telling you, you're not going to be better off at the end of June than you are in April by essentially taking 100,000 and just deploying it into your payroll. This is a great example of that PPP financing. If I were in your shoes, I'll tell you what I would do in this situation. I know I have 8 weeks, which puts me through mid-April all the way through mid-June. I would not be hiring anybody in April. I would remove the 25,000 in April. And then in May, I would probably start bringing on some people. So let's say we bring on 25,000 worth of payroll. And in June, let's say we only bring on 25,000 in June. So unfortunately, it means I'm only going to have about, give or take, $50,000 of that 100,000 that's going to be quote unquote forgiven. But I at least have some money left as dry powder. And I'm going to continue to be prudent and say in July, if I'm not going to be at my $100,000 revenue run rate, then I surely don't need that much in payroll. I'm going to drop that by a quarter. So let's call that 1250 or 25,000. Let's call it 25,000 for ease. And let's do 25,000 in August. So this is what's called right-sizing your business, right? When companies are in turnaround mode, you have to begin to think about not where I used to be, but what is my current paradigm? And I would even say in September, I'm not sure I need $50,000 in payroll when I'm doing half of my revenue. So I would drop that down by 25. Now I'm starting to get a little bit of money in the bank. Unfortunately, 100,000 minus 35,000 is 65,000. And I only had 50% of that 100,000 forgiven. But you know what you've done? You're surviving to fight another day. Here's a great example of taking that 100,000, planning wisely, having enough dry powder in 6 months to fight another day. So I'm going to pause here for a second. I just threw a lot at you guys, but this is my worst case versus my base case. Going into this, think about all of the high-level drivers that can affect your business and then put numbers to it. Let's start with the base case first. I'm going to pause here. If anybody has any questions, I just threw a lot at you. Maybe I'll let Steve jump in to give a different perspective.
Yeah, in terms of thinking about your forgiveness, forgiveness is forgiving debt, right? It's not a cash infusion to the business. That's already been done with the debt financing. In this case, if let's just for simplicity, let's say that the PPP got dispersed on May 1st, so May and June are our forgiveness period. Let's say that those are exactly 8 weeks. In this scenario, we would have 50,000 of that forgiven. Now we're not open in May and June. So what are those people doing at 50% of our people capacity? They might be fixing up the restaurant. They might be rearranging the restaurant so that we can accommodate a different footprint, table space further apart. But it could be argued, that I'm not going to be able to put those people to use productively. So why am I bringing back $25,000 worth? Maybe it's only $5,000 worth in May and June, and I only get $10,000 forgiven, and I still have $90,000 of debt on the books. That's got to go into like the 12-month cash flow planning in terms of how am I going to repay that loan. Like, part of the limitations here is we're only going 6 months out, but after 6 months, the principal and interest needs to start being paid back, whether that's 90,000 or whether that's 10,000 that's remaining of the PPP loan. For a different business that's at half revenue capacity, the profile is going to look a lot different. But this helps kind of give the visual of where's the money coming from, where's the cash coming from, and where's it going. And at the end of the day, at the end of the 6 months, what is my expected ending cash balance? Right here in this scenario, as Dan was just saying, like we still have 35,000 in the bank. Now we've burned through a lot more cash, but at least we still have 35,000. At least we're still alive. But if this was a business that you really did not believe was going to be able to survive for once the economy kind of turns back on, let's just say that the fundamentals are just not there, then we would say that we really got to think about what is the business model, what can be changed to make it viable. And if you don't believe it's going to be viable, then we really should talk about what are our other options. What else can we do besides taking the PPP monies?